Summer, 1929. While millions of Americans are buying stocks with borrowed money, convinced the boom will last forever, Bernard Baruch is doing something nobody expects. He's selling, quietly, methodically, converting his entire portfolio to cash and government bonds. His friends think he's lost his mind. The market hits new highs every week. Why would anyone exit now? Baruch has a simple answer. When taxi drivers start giving you stock tips, when your cook follows the ticker tape, when beggars on the street offer investment advice, you're not at the beginning of something. You're at the end. And Baruch has lived through enough market cycles to know exactly what comes next. Across town, Joseph Kennedy is having a similar realization. The story that would become famous suggests it was his shoeshine boy who triggered Kennedy's exit. Whether that specific detail is precisely true or has grown in the telling, what we know for certain is this. Kennedy understood a mathematical truth that most people couldn't see. If the shoeshine boy is in the market, there's nobody left to buy. That's the top. And Kennedy liquidated everything. Meanwhile, Jesse Livermore is doing more than just getting out. He's positioning to profit from the chaos he knows is coming. Throughout the summer and fall of 1929, Livermore builds massive short positions. He's not hoping the market falls. He's betting everything that it will. And he's been right before. He made millions shorting during the panic of 1907. This time, he's going for something bigger. These three men, along with a handful of others who understood market psychology and leverage, saw what was invisible to everyone else. The biggest financial catastrophe in American history wasn't a surprise to them. It was an opportunity they'd been preparing for. And while the crash would destroy millions of ordinary Americans, these insiders would profit spectacularly. The question isn't whether the crash was coming. The question is, what did they see that everyone else missed, and why does it matter right now in 2025 when all the same warning signs are flashing again? To understand what these men saw, you need to understand the intoxication everyone else was feeling. The Roaring Twenties had given America something it had never experienced before. Mass prosperity, new technology everywhere, radio connecting the country, Ford putting automobiles within reach of ordinary families, electricity transforming daily life, and the stock market reflecting all of this with returns that seemed magical. From August 1921 to September 1929, the Dow Jones climbed from 63 to 381, 6 times higher in 8 years, over 20% returns annually. The kind of gains that make people believe they've discovered perpetual wealth. But while ordinary investors saw opportunity, the smart money saw something else. They saw the fuel behind those gains. And it wasn't economic growth, it was leverage, debt, borrowed money flooding into stocks at levels that defied logic. By August of 1929, brokers were lending over $8.5 billion on margin. Here's the number that should stop you cold. That was more than the entire amount of physical currency circulating in the United States. More borrowed money in the stock market than actual dollars in existence. Baruch saw this. Kennedy saw this. Livermore saw this. And they understood exactly what it meant. Leverage amplifies everything. Gains on the way up. Losses on the way down. And when millions of people are all leveraged in the same direction, you create a mathematical death trap. Because brokers don't let you lose their money. In the early 20s, you might need 20 or 30% down to buy stocks on margin. By 1929, some brokers offered 90% leverage. You could control $10,000 of stock with just $1,000 down. Now here's the math that Livermore understood better than anyone. If that stock goes up 10%, you've doubled your money. Beautiful. But if it drops 10%, your entire investment is gone. And if it drops more than 10%, you owe the broker money. You're in debt for the privilege of losing everything. And when stocks start falling and millions of investors get margin calls simultaneously, they all have to sell at once. But who's buying in a falling market? Nobody. So prices fall further. More margin calls. More forced selling. It's a self-feeding cascade that doesn't stop until every bit of leverage has been purged from the system. This is what the smart money recognized, not through some mystical ability to see the future, but through basic mathematics. When leverage reaches extremes, when everyone believes prices can only go up, when borrowed money exceeds the money supply itself, you're not at the beginning of prosperity. You're at the end of a cycle that's about to snap back violently. But the smart money faced a problem. They were contradicting the experts. And not just any experts. Irving Fisher, arguably America's most respected economist, was telling everyone the opposite. Fisher was a Yale professor, an inventor who'd made millions from his visible card filing system, a mathematical genius whose theories about interest rates and monetary policy were revolutionary. On October 15, 1929, Fisher stood before an audience and declared that stock prices had reached what looks like a permanently high plateau. This wasn't dismissed as crazy talk. This was the consensus, the mainstream view, the expert opinion that everyone trusted. But Baruch didn't trust expert opinion. He trusted market behavior, and market behavior was screaming danger. Livermore didn't care what Yale professors said. He cared about crowd psychology, and the crowd was exhibiting classic peak euphoria. Kennedy didn't need economic models. He needed to see who was buying. And when everyone was buying, that meant the smart money should be selling. While Fisher was proclaiming permanent prosperity, Baruch was already out. While newspapers celebrated new highs, Kennedy was liquidating. While ordinary investors borrowed more money to buy more stocks, Livermore was building short positions that would pay off when everyone else got destroyed. The smart money had identified specific warning signs that the public couldn't see, or more accurately, that the public didn't want to see. First, the Federal Reserve had been tightening throughout 1929. Interest rates climbed from 5 to 6%. That's the central bank trying to cool speculation. When the Fed stops printing easy money, the party's ending. The professionals knew this. The amateurs ignored it. Second, European money was fleeing. British banks had watched American stock prices climb beyond any rational valuation. They knew what goes up without fundamental support must come down hard. Throughout September and October, foreign investors quietly liquidated their American holdings. The money was already safely across the Atlantic before the crash hit. Third, margin calls were increasing weeks before Black Thursday. People were struggling to meet their obligations during the good times. That's a flashing red light. If leveraged investors can't handle small pullbacks, what happens during a real decline? The smart money didn't need to guess. They'd seen this pattern before. Fourth, trading volumes were hitting extremes. On the surface, this looked like enthusiasm. To experienced traders, it signaled distribution. When volume spikes during a rally, it often means large players are unloading positions to smaller investors who still believe the story. It's the classic pattern, professionals selling to amateurs at the top. But perhaps the most important signal was institutional. And this is where it gets really interesting. Because the leverage wasn't just individuals borrowing on margin. Wall Street itself had created a pyramid of debt that would amplify the crash far beyond what most people could imagine. The smart money spotted another danger that ordinary investors completely missed. Investment trusts. These were the hot new financial innovation, marketed as safe diversification managed by professionals. The pitch was seductive. You don't know which stocks to pick. Let the experts at Goldman Sachs handle it for you. Safety through professional management. But Livermore, Baruch, and Kennedy saw through this immediately. These weren't safe investments. They were leveraged pyramids, and when they collapsed, they'd magnify the crash exponentially. Goldman Sachs created their trading corporation in December 1928 with $100 million in capital. Shares offered at $104 rocketed past $200 within months. Success breeds imitation, so they created Shenandoah Corporation in July 1929. Same structure, more leverage. Then Shenandoah created Blue Ridge just 25 days later. 3 layers of leverage, each level amplifying the gains and losses below it. By year's end, Shenandoah had 62.4 million of its 122 million assets in Blue Ridge. Goldman Sachs Trading had 55 million of its 250 million in Shenandoah. It was a Russian nesting doll of debt. When one piece fell, they'd all fall. The smart money looked at this structure and saw the same thing they'd seen in the margin debt numbers: mathematical inevitability. These trusts couldn't survive even a modest decline. And if the market crashed hard, these instruments would amplify the destruction. They'd turn a bad crash into a catastrophic crash. So while ordinary investors poured money into Goldman Sachs's pyramid, the professionals were heading for the exits. They weren't just avoiding the trusts, they were avoiding the entire system that had created them. Because when leverage is piled on top of leverage on top of leverage, you don't need to predict exactly when it breaks. You just need to know it will break, and you need to be positioned correctly when it does. As September turned to October, the smart money was executing their final positioning. Baruch had already converted to cash and bonds. Kennedy had liquidated his stock holdings, but Livermore was doing something more aggressive. He was building massive short positions, not just avoiding the crash, positioning to profit from it. Short selling is simple in concept, but requires nerves of steel in execution. You borrow shares from a broker, sell them at current prices, then buy them back later at lower prices to return to the broker. If you're right and prices fall, you profit from the difference. If you're wrong and prices rise, your losses are theoretically unlimited. Livermore had been shorting since early 1929, but as October approached, he dramatically increased his positions. He understood crowd psychology. Once panic selling starts, it feeds on itself. Margin calls force selling. Forced selling drives prices lower. Lower prices trigger more margin calls. It becomes a mathematical cascade. The smart money had another advantage most people don't talk about: information networks. These weren't insider trading conspiracies. They were relationships built over decades. Private dining rooms where financial elites shared observations. Phone calls between old colleagues comparing notes. When you're connected to other professionals who read the same signals, you can coordinate timing without explicit collusion. The evidence suggests that in the final weeks before the crash, conversations among the wealthy intensified. Not criminal coordination, strategic information sharing. Baruch had mentioned taxi drivers giving investment advice. Kennedy heard similar stories about shoe shine boys. When multiple independent sources report the same saturation signals, that confirms your thesis. The top is in. Then came the first warning shot. September 5th, 1929. Roger Babson, a well-known economist, stood before a business conference and predicted a crash. He said the market could drop 60 to 80 points. The press dismissed him. The public ignored him. But the smart money took note. Not because Babson had unique insight, but because his public warning might spook enough investors to trigger the decline. The market did start falling through September, not collapsing, just declining. Enough to make leveraged investors nervous, enough to generate some margin calls. The professionals watched carefully. This was the test. If the market could handle modest pressure, maybe the leverage could sustain itself longer. If selling accelerated, the cascade was beginning. October 24th, Black Thursday. The test failed spectacularly. Nearly 13 million shares traded, 3 to 4 times normal volume. The ticker tape fell hours behind. Prices displayed were obsolete by the time brokers saw them. Chaos was building, and the smart money was ready. At noon, prominent bankers met: Thomas Lamont from J.P. Morgan, Albert Wiggin from Chase, Charles Mitchell from National City. They formed a pool to buy blue-chip stocks at above-market prices. The strategy had worked in 1907. It stabilized the market temporarily on Thursday. Some thought the panic was over. The smart money knew better. This was a brief pause before the real destruction. Here's what the public didn't know. While those bankers were publicly buying to support the market, at least one of them was privately selling. Albert Wiggin, head of Chase, began shorting his own bank's stock even as he committed Chase's capital to the support pool. He shorted over 42,000 shares. When the crash continued, Wiggin made over $4 million, publicly supporting the market while privately betting against it. That's not integrity. That's strategy. Friday was relatively calm. Saturday, markets were closed. Sunday, amateur investors tried convincing themselves it was just a correction. The smart money spent Sunday preparing for Monday. Black Monday. October 28th. The Dow dropped 12.8%, 38.33 points, the largest single-day decline in history. Livermore's short positions were printing money. Every point down was profit multiplied by his massive positions. But Tuesday was the day that changed everything. Black Tuesday, October 29th. 16 million shares traded. The systems couldn't handle the volume. The Dow dropped another 11.7%. In 2 days, the market fell 23%. Billions evaporated. While ordinary investors watched their savings disappear, while margin calls destroyed families, while panicked selling consumed the market, the smart money was executing with precision. Livermore was covering some shorts at massive profits while establishing new shorts for the continued decline. Kennedy, already out, was beginning to position for eventual bargains. Baruch, safe in cash, was waiting patiently. This wasn't luck. This wasn't genius. This was preparation meeting opportunity. They'd read the signals. They'd understood the mathematics. They'd positioned accordingly. And when the inevitable happened, they profited while millions suffered. The destruction didn't end on Black Tuesday. The market rallied briefly in November, giving false hope, then fell again and again. For nearly 3 years, the bleeding continued. By July 1932, the Dow hit 41.22, down 89.2% from the September 1929 peak. Imagine investing $100,000 at the top. By the bottom, you'd have $11,000 left. If you held without selling, if you'd been on margin, you'd be in debt. You'd owe money on top of losing everything. The human cost was devastating. Millionaires became beggars overnight. Banks failed by the thousands. By 1933, almost half of American banks had collapsed. People who'd never touched stocks lost their savings because their bank had loaned money to someone who had. But while millions suffered, the smart money prospered. Jesse Livermore made over $100 million shorting the crash. In 1929 dollars, multiple billions in today's terms. Bernard Baruch preserved his entire fortune and remained a respected advisor to presidents for decades. Joseph Kennedy not only avoided the crash, but made additional profits shorting on the way down, though exact amounts are disputed. These weren't lucky guesses. They were calculated plays based on reading signals the public couldn't or wouldn't see. And here's the lesson that matters. The experts got it completely wrong. Irving Fisher, the brilliant economist who proclaimed stock prices had reached a permanently high plateau, lost everything. His fortune between $10 and $11 million wiped out. He bought stocks on margin as they fell, convinced his theories were correct, and the market was wrong. By 1932, Fisher was financially ruined. He borrowed $750,000 from his sister-in-law to cover losses, sold his mansion to Yale, and rented it back. 3 years later, Yale forced him out. He never recovered financially, spent the rest of his life borrowing from family, died at 80 in 1947, still dependent on others. Fisher wasn't stupid. His economic theories remain influential today. But he made the fatal mistake. He trusted his models more than market behavior. He believed fundamental analysis justified prices. He failed to account for leverage and speculation pushing valuations beyond any rational level. Meanwhile, the people who ignored expert consensus and trusted their understanding of leverage, psychology, and crowd behavior, they survived and profited. That's the real lesson. Markets reward preparation and the ability to read signals, not belief in expert opinion, not following the crowd, not trusting that this time is different. And here's why this matters right now, in 2025. Because every warning sign the smart money recognized in 1929 is flashing again. The smart money today sees the same pattern, and they're positioning accordingly. While everyone else celebrates new highs and believes in permanent prosperity, the leverage today is actually worse. It's not individuals buying on margin anymore. It's institutional. Hedge funds using derivatives, corporations borrowing billions to buy their own stock, private equity loading companies with debt, pension funds reaching for yield in increasingly risky assets. The total notional value of derivatives globally runs into hundreds of trillions. Nobody knows how these interconnected positions will unwind in a crisis. The Federal Reserve has spent 15 years inflating asset prices, quantitative easing, zero interest rates, forward guidance. The S&P 500 went from 676 in March 2009 to over 5,000 today, 7 times higher in 15 years. That's faster than the 1920s bull run, but fueled by cheaper money and more leverage. And just like in 1929, the authorities insist it's fine. The Fed has tools. Stress tests ensure safety. Circuit breakers prevent panic. Modern risk management is sophisticated. This time is different. We've learned from the past. That's what they always say. Right until the moment it breaks. The smart money today isn't listening to central bankers or Wall Street strategists. They're reading the same signals Baruch, Kennedy, and Livermore read. Saturation signals, leverage warnings, distribution patterns, and some of them are quietly positioning. Not publicly, not obviously. But they're preparing for what the math says is inevitable. When everyone believes something can't fail, that's when it's most likely to fail. When debt becomes normal, when leverage is considered smart planning, when speculation is called investment, that's the top. The smart money understands this. They understood it in 1929. They understand it today. The question isn't whether another crash is coming. The question is whether you can see the signals. Can you read market behavior independent of expert opinion? Can you recognize when everyone being positioned the same way creates fragility? Can you act on conviction when it contradicts consensus? Baruch got out because his taxi driver and cook were giving stock tips. Kennedy sold when his shoeshine boy offered investment advice. When everyone is in the market, there's nobody left to buy. That's basic mathematics. And mathematics doesn't care about expert opinion or mainstream consensus. The crash of 1929 wasn't a surprise to the people who mattered. It was an opportunity they'd prepared for. They saw the warning signs, they understood the leverage, they positioned accordingly. And when the inevitable happened, they profited while everyone else got destroyed. History doesn't repeat exactly, but the patterns rhyme. The leverage is there, the confidence is there, the saturation is there. The warning signs are flashing, and somewhere right now, the smart money is positioning. Not hoping for a crash, just preparing for what the math says is coming. If this changed how you see markets and what's happening right now, hit that subscribe button. Because when the next chapter unfolds, and based on every historical pattern it will unfold, you'll want to understand what the smart money saw and when they saw it. The answers aren't in forecasts or predictions. They're in reading signals and understanding patterns. And I'll be here to show you what to watch for and how to interpret what you're seeing. Thanks for watching.